Good evening, everyone. Time for another silver update. This is the 1 minute chart of silver overlaid over gold from netdania.com. You can click on the link below. Now, we had a interesting move in the metals markets today. We're going to play some of the Bernanke testimony. Of course, you can see the volume coming in. This is going to be silver volume. Similar volume came in on the gold. And we're going to try to parse and see what that means. But what I wanted you to look at here that's really important is that when we do this overlay, you can see that the silver price is the leader. That's quite clear here. You can see anytime you on this chart, when you have the first one listed, that's going to be the one in candlesticks, and the one behind it's going to be in a line chart. So the candlesticks are silver, the line chart is gold. And now as we parse out the video here, I can't tell you exactly what words were spoken at what time. So I'm just guessing about that. It'd be a very interesting study if someone could see what words were spoken at exactly this 10 a.m. point. Now you can see what's interesting about this 10 a.m. point is that silver took off. And I'm assuming that's corresponding with the hint that the FOMC does not intend to scale back the quantitative easing and the $85 billion worth of purchases. I'm just guessing. I don't know. But the interesting thing here is that silver took off. Gold flatlined. Then gold followed the takeoff. Then silver topped and started to fall back. Gold continued to rally, but silver came down, then gold came down. Silver bounced, then came way down. Gold followed it, and we can see that now we have a little divergence here where we get silver selling off even into new lows below this low right here, whereas gold is rallying, and finally gold succumbs. So it seems to me pretty clear here that silver is actually leading gold as far as the reaction to the jawboning of the Federal Reserve Chairman. Now, what does that mean? I have no idea what that means. I can hazard a guess that perhaps that means that if silver is trading as an industrial commodity, that a continued boom or a incipient boom in the world economies due to lowered interest rates. We're going to see that none of that's true, but we're trying to figure out the speculation that perhaps the Fed will succeed in stimulating the economy finally after I don't know how many years, and therefore we're going to see a recovery, and therefore silver is going to rally on the industrial demand that's perceived there. That seems kind of a shaky interpretation. The other interpretation would have to be that the words of the chairman indicate continued inflationary pressures, even though the Fed doesn't admit those, and therefore that's very bullish for the precious metals ultimately, and then silver takes off. Now, what is the interpretation of that? Does that mean that silver is a more important inflation hedge than gold and actually leads gold as an inflation hedge? And the stacking of silver has taken over as the primary driver of its price as opposed to the industrial consumption of it. So those are two different interpretations you can make. I don't know which one is true. If anybody does bother to parse out the timing of these exact statements of what caused the 10 a.m. rally, I'd be interested to know. Now, over to the kookaburra that I noticed. Actually, I was pointed out to me by a viewer that this snake preview was on there. What's interesting about this is the thing sold out. I think there were 9,000 or something like that, and it sold out. They got more in. I think they got 1,000 in. Now they've got about 194 of these. So the people who bought based on my pointing that out, or maybe it's just coincidence. Anyway, they got about 20% of this issue. That's very interesting. that's 20% of the issues selling out so fast. Now we can see on the price here at 31.18 and 31.19 that perhaps APMEX has repriced this based upon this coin, which is the standard 2013 Kookaburra. I would have always expected the snake issue with 10% of the mintage to be a higher price, but that seemed to be a pricing anomaly. These are things that I look for in the semi-numismatic coins because when you have manipulated markets, one of the things you see are pricing anomalies. And that's because the people who are retailing these coins, they hedge them. They don't know when to buy them. They're trying to move stock. So sometimes the prices may be based on overstock, and so it's just a guessing game as to what's going to be the future potential of these coins. My guess was that this one has a very good potential, and I agree with the viewer that pointed that out. So very interesting the way we have, I won't say it's mispricing, but we have lack of pricing information in some of these semi-numismatic coins, and that's the type of thing you see in manipulated markets or markets that are somewhat disjointed as we're seeing. So what the meaning is of why silver bounced first, maybe that will come out here in the testimony. So I wanted to look at a little bit of the testimony here. Now, I wanted to compare Bernanke here real quick to Obama and Holder. So it looks like we may have some hair club for men moments coming here. It looks like, well, let me just say that I don't think any of these jobs are jobs that you really want to have if you don't want to age very quickly. We'll just leave it at that. So let's get to Bernanke's testimony here. Now, I skipped most of it about his hemming and hawing about why he's continuing and why it's good news that inflation is still very low, but unemployment is a little bit too high. And if you remember the last time I covered Bernanke's statement, he got grilled over the coals pretty hard about the punishment of savers, and he seems to be trying to get ahead of that game here with his statement. So he outlines a little bit of the risk of what he's doing, and it looks like he's coming closer to an admission that he may be in a kind of a box. So let's listen to what he has to say here.
In the current economic environment, monetary policy is providing significant benefits. Low real interest rates have helped support spending on durable goods, such as automobiles, and also contributed significantly to the recovery in housing sales, construction, and prices. Higher prices of houses and other assets in turn have increased household wealth and consumer confidence, spurring consumer spending and contributing to gains in production and employment.
So let's stop there. So house prices are going up, and that is increasing household wealth, and that's spurring, that sounds kind of like the housing bubble revisited, but we'll continue.
Importantly, accommodative monetary policy has also helped to offset incipient deflationary pressures and kept inflation from falling even further below the committee's 2% longer run objective. That said, the committee is aware that a long period of low interest rates has costs and risks. For example, even as low interest rates have helped create jobs and supported the prices of homes and other assets.
Okay, have they? Have low interest rates helped to create jobs? Or are you going to argue that we haven't lost as many jobs as we would have lost if we wouldn't have had those low rates? I think he's begging the question, do your low interest rate create jobs maybe in the banks? I'm not sure.
Savers who rely on interest income from savings accounts or government bonds are receiving very low returns. Another cost, one that we take very seriously, is the possibility that very low interest rates, if maintained for too long, could undermine financial stability.
How's that? Is that something similar to what's happening to the JGBs that are halted right now, and Japan with its 30 years of this policy, which hasn't worked in 30 years?
For example, investors or portfolio managers dissatisfied with low returns may reach for yield by taking on more credit risk, duration risk, or leverage. The Federal
Okay, so the risk is that because he suppressed interest rates so low, we know we still have pension funds in the states, California, a lot of other states that still have an assumed return of 7 and 8% based on their projected liabilities. So if Bernanke's bonds are yielding 1% or less, where are they going to get this yield? So now he's also admitting to the fact that these extended interest rates could cause investors to over leverage themselves or could cause them to chase dangerous yields. It seems to be that he's starting to hint at the dangers of his policy. It looks like he's starting to admit that he may be in a box.
Federal Reserve is working to address financial stability concerns through increased monitoring, a more systemic approach to supervising financial firms, and the ongoing implementation of reforms to make the financial system more resilient.
So somehow regulation is going to improve this problem of the rates are so low that there's no yield. And so if we regulate things tighter, then somehow that's going to create a 7% yield that's safe. I don't see how those add up.
More resilient. Recognizing the drawbacks of persistently low rates, the FOMC actively seeks economic conditions consistent with sustainably higher interest rates. Unfortunately, withdrawing policy accommodation at this juncture would be highly unlikely to produce such conditions. A premature tightening of monetary policy could lead interest rates to rise temporarily, but would also carry a substantial risk of slowing or ending the economic recovery and causing inflation to fall further. Such outcomes tend to be associated with extended periods of lower, not higher, interest rates, as well as poor returns on other assets. Moreover, renewed economic weakness would pose its own risks to financial stability. Because only a healthy economy can deliver sustainably high real rates of return to savers and investors, the best way to achieve higher returns in the medium term and beyond is for the Federal Reserve, consistent with its congressional mandate, to provide policy accommodation as needed to foster maximum employment and price stability. Of course, we will do so with due regard for the efficacy and costs of our policy actions and in a way that is responsive to the evolution of the economic outlook. Thank you, Mr. Chairman.
All right, so let me translate that last statement for you, which Bernanke seems to be saying that we would like to have an economy that can have consistently higher rates that can return a decent return to investors, but we don't have that because we haven't stimulated enough growth in the economy to make the economy healthy enough to the point where we can raise rates. So we need to keep rates low to create a situation where we can raise rates. So I guess the assumption here being, and I think we've seen that Japan has failed in bringing that about, the assumption is that continued low rates will eventually, and not only low rates as he admitted earlier, but low rates and in addition to them, outright buying of assets, including junk, mortgage-backed securities, will eventually lead to this situation where the economy strengthens and then they're going to be able to raise rates. Of course, the problem with that is that, in fact, these lower rates are not stimulating the economy. They're not causing employment to increase, even though he hinted at that employment is getting better. Actually, he cited by name, he cited the job participation rate, which is the first time I recall him mentioning that, saying that it is falling. And so, again, he's not stimulating the economy with his low rates, and he's telling us that we have to keep these low rates until they stimulate the economy, because that's the only way we're going to get higher rates where we can get return on savings. So very confused testimony. It appears that Bernanke is in a box, and he says he would like to raise rates, but unfortunately things aren't healthy enough for him to raise rates. So he's going to keep rates low until things are healthy enough for him to raise rates, which hasn't happened for a very, very long time. So we had a rally and then a smackdown. That's to be expected. I can't remember any time in the recent past where Bernanke has opened his mouth and it has ever resulted in a continued rally. It normally results in, and you can see the size of the rally, we're talking about a 3%, nearly a 3% move. We're actually talking here about a 4.5% decline. So we had the rally based on the idea that we need to just keep printing money, but then there's some backing off or selling. And again, it's just a typical thing. So it appears that Bernanke is in a box. They used it as an opportunity to contain prices. We got a sell off and we're back down to that 22 level. We still haven't revisited that 20 level, and as I pointed out last time, that 20 level, and now you can see it when we look on the chart and remove all of the technicals. You can see that it definitely was on a very bizarre candle spike. That's the type of thing that you get when you just can't trade. This price move, a good $1.22 of this price move was at a time that no one can trade. So it was essentially a flash crash in the price, but we do seem to be attempting to revisit this, and we still seem to be in the downtrend on the paper price. Of course, we have hints at possible coming force majeure. We had ABN AMRO. We had stories about Hong Kong exchanges, and if you want to follow those stories, you can go to King World News. There's a lot of stuff covering that. So at a time when the price is falling, and a lot of people have covered these issues, Andy Hoffman and many, many others have talked about the fact that this is not the type of thing that you see in a bear market. We would expect to see a lot of supply. We are seeing a lot of paper supply, but we're actually seeing physical shortages, and that's indicative to me of a market bottom. But then again, I may be wrong. They may take the paper price lower. Had a lot of people on the YouTube channel recently, and some of them have been spamming the channel and been banned for such. Mostly traders who have talked about how I've been wrong in my trading. Of course, I don't trade silver. I'm interested in stacking silver, and I'm interested in looking for low points, good price points to stack. I don't think it can really be argued that this is not a good price point to stack. As you can see, we've revisited that Bear Stearns top. And so obviously I'm not coming from a trading perspective. I have no interest in trading silver. Silver to me is the most undervalued asset in the history of the world. My only interest is in accumulating more silver because it's so undervalued. That's based on a fundamental view. I know a lot of people disagree with me on the fundamental view, but I believe that ultimately fundamentals will out, and with the fact that Bernanke is in a box, he really can't stop printing money. I think that the only place for silver to go at this point is going to be up. We may get another dip down. I think that if we do get dipped down into the teens, I'm going to be watching very closely to see what the premiums do, and we'll see if we can actually get anything cheaper than what we have right now. And we'll talk to you next time.